in the area. So needless to say, we are all in unprecedented times, and we're experiencing firsthand the effect of a pandemic, not only on our day-to-day life, but on the economy, and very much about how that pandemic affects our ability to receive care and deliver care. So it really highlights just how important digital health is and how innovation in healthcare is now and is going to be in the coming years. And for the many attendees who attended the talk with Ramesh, that was a key topic as well. So this is very timely. And just a couple of notes before we dive in. One is that, so we'll do the panel discussion first with our panelists, and then we will have a Q&A session. So I wanted to invite all of our attendees to please submit your questions throughout the talk, but in the Q&A panel, not in the chat panel, because we'll be looking really at the Q&A panel to collect and curate questions that I'll be sharing at the end. So again, please feel free to submit your questions, but through the Q&A panel and not the chat panel. So now I will hand it over to Mohanjit to introduce our panelists and start the discussion. Thank you.
Fantastic. Thank you so much, Afsana. I hope you can hear me and see me clearly. Wonderful. So for everyone watching, listening, we have a phenomenal panel today of both investors and somebody who is from the M&A world, just to give a complete picture of what in the world is going on. And this truly is, as Afsana said, unprecedented. So nobody has a playbook, right? And so we're gonna see what we can learn from previous crises, and the goal here is to have a very candid, open, what I call sort of no BS conversation, and hopefully at the end of it, those in the audience, you know, whether you're technologists, practicing physicians, entrepreneurs, investors, can take something tangible from this, if not to act on, then at least as fodder for discussion and further deliberation within your respective organizations. So with that, what I'm going to ask each of the three panelists to do is just do a quick, I call it a Twitter bio, sort of 1 to 2 minutes of who you are and the organization that you represent. So maybe Michael, if you're okay with it, we'll lead off with you.
Sure. Thank you, Mohanjit and Afsana, for having me, and the rest of the MIT club for having me. I'm Michael Yang. I'm a managing partner with Omer's Ventures. And Omer's Ventures is a 9-year-old venture fund. We're transatlantic with offices here in Palo Alto, Toronto, and London. And we're a technology venture capital fund that likes to invest in very disruptive and interesting companies. I lead our healthcare investment area, and we have a bunch of sectors and areas that we like to pursue, of which healthcare is one of them. And happy to be here today and tell you more about you know, what we think about this particular interesting climate, and answer any other questions that you have.
Thank you, Michael. Over to you, Sebastian, next, please.
Hi, I'm Sebastian Kaleri, and I'm a principal on the investment team at 8VC. 8VC, for those of you who don't know us, is a San Francisco-based venture capital firm managing a bit over $3 billion, and we invest primarily in 2 thesis areas. One is smart enterprise, so essentially vertical SaaS, and the second area is what we call bio-IT, so essentially companies at the intersection of biology and computation and data science, which can include therapeutics, diagnostics, research tools, things like that. We invest primarily at the Series A and B stage, although we do a little bit of seed investing as well. And I think notably, a decent chunk of our firm at any given time is focused on build projects and spinning up new companies internally. My focus within 8VC is primarily within the smart enterprise thesis, and in particular focusing on healthcare. Although as a firm, we tend to take sort of a broad look at you know, a bunch of different areas, and we don't specialize entirely in one area. And so I also spend some time in manufacturing, energy, and a few other areas as well.
Thanks, Sebastian. And last but not least is Vinny, representing Woodside Capital. Vinny.
Thank you. Thanks, Mohanjit and Afsana, for having me on the panel. So I actually lead the digital health practice at Woodside Capital in Palo Alto, which is a boutique investment bank. We've been around for about 20 years, mid-market, I guess mid-market, about $8 billion in transaction at this point. And we have a practice that covers anywhere from computer vision to SaaS to digital health. And I lead the digital health practice.
Thank you. Thank you all so much. So let me just spend about 30 seconds on myself, perhaps. So I am a co-founder of a mid-stage tech fund that does US-India cross-border investing called Iron Pillar. Previously, I spent almost a decade with a firm called DFJ, where I went through the global financial crisis. And prior to that, I spent 8 years with a gentleman named Guy Kawasaki at Garage, used to be called Garage.com, then Garage Technology Ventures, a seed stage technology fund where we went through the dot-com crisis. So it seems like I've hit a separate crises or crisis across 3 major venture gigs that I've had over my career. So without further ado, let me sort of dive in into the Q&A. First, I'm going to ask the panelists to do what I call look inwards, which is look at your existing portfolio, your existing engagements perhaps, and what advice, what sort of tangible, crucial advice are you providing your current portfolio companies? And perhaps if you can be as specific as possible, that would be fantastic. And again, Michael, maybe I can ask you to go first.
Sure, would be happy to. So obviously, as things started to trickle in from a news front in late January, much of February, I think by early March, we were having conversations with all of our portfolio companies in advance of the shelter-in-place kind of advice that, hold the phone, stop the train, right? Figure out and assess the current situation and what is going on. I think, we've backed some phenomenal founders and CEOs, so they have had prior experiences like many of us through other interesting times, and they quickly got on to setting a new cadence and a new operating plan going forward. Specifically, I think without a doubt, every portfolio company went into a hiring freeze, right? Let's just kind of lock down the spend and again, kind of assess the current situation. I think the next thing, as early prognostications were, hey, this might be a V-shaped snack back recovery, so we don't have to do too much surgery on kind of our organism right here, and we can continue on. As that kind of started to change kind of every few days and every few weeks, I think people started to become more acknowledging that this is going to be a U-shaped recovery, and therefore it's going to take a lot more time. So that's when you kind of went into the mode of maybe we need to look at reductions in force. Maybe we need to look at furloughs. So just really batten down the hatches on the OPEX and the CAPEX side and doing a lot of expense audits. I think concurrent with a lot of focus on extending runway and weathering the storm was, how are we actually going to work as a team, as an organization, a company in this environment, right? Once we went into shelter in place, especially for our Bay Area portfolio, which was earlier than some of our other markets, and very quickly focused in culture and remote working and what that actually meant for the portfolio company or the organization. So some companies weren't necessarily equipped for remote working, so they quickly dispatched PCs and laptops and monitors and equipment to the home, made sure you had broadband bandwidth, made sure that you had VPN access and other remote access to necessary IT mission critical systems. And then very soon it became culture, which is how are we going to connect? Is it one-on-one? Is it Zooms? Is it, phone calls? Is it stand-ups? How do we bring some levity and some life to kind of the new normal? So I would say that's what we did, which is first look at the situation, come to your own internal belief on how long it's going to last, and then kind of figure out financially how you're going to run the business, and then very quickly reset culturally to figure out how you're going to run your own company in that environment to continue to maximize the potential of your team and more importantly, support your team, because everyone's kind of going through this for the first time.
No, fantastic. And before I go to you, Sebastian, Michael, just think about the follow-on that I have in my mind, which is we're in this new normal, and we're going into what may be the new normal. And so I'll come back to you in terms of, what is your best guess in terms of, how work and culture perhaps changes as a result of this catalytic event. But Sebastian, going to you, anything different than what Michael said? And if, of course, you're now sitting on a new fund that you've been, in a wonderful position to have raised fairly recently. So you've got capital to deploy, but in terms of existing portfolio companies, what's the messaging?
Yeah, some similarities and some differences from Michael's approach. I think I'll sort of preface this with, we are dealing with a lot of uncertainty, and a lot of very smart people have been very wrong about what the world would look like in April. And people who are trying to predict what things are going to be like in Q3, Q4, there are big error bars on that. So with that in mind, there's a world in which, we're back to life as usual with masks by Q3. There's also a world in which demand destruction cascades and the economy is in a bad place for significantly longer. And with that in mind, we've been working with all of our portfolios, and similar to Michael, early in March, we sat down with each of them, just went down the list. And the first thing we did was work on operating plan, and basically got down to a point where burn had us at 18 to 24 months of runway. For some people, for some companies, this meant hiring freezes. For only a small handful of our businesses did this actually mean layoffs or anything like that. For some people, it's less spend on marketing, but really working with them. And then for a handful of companies as well, raising additional capital. But really rapidly getting to a place where you have an operating plan that lasts you 18, 24 months, cash lasts you 18, 24 months. We're also advising, so to the point about uncertainty, we're also advising our portfolio companies to have a plan B. If you need to go into survival mode, better to think about that now and be prepared for that now, and be prepared for the worst of things, and know what you're going to do if we end up in the worst case scenario. On the flip side, I'll also highlight that a number of our portfolio companies have also been able to accelerate work they're doing, and this has been a really great opportunity for them, particularly in healthcare. For instance, and perhaps I'll have the chance to talk a little bit more about this company later, but we have one portfolio company called Livongo Health, which is a risk-bearing primary care clinic based in New York. And this was a great opportunity to actually accelerate a lot of the product work they were planning on doing in order to enable virtual care. So honestly, it's been a hectic couple of weeks, but I think most of our portfolio companies have been able to make these adjustments in a good way.
Yeah, and I think that's very good advice for all entrepreneurs who may be on on this call or this video, where I always say that being nimble, being flexible, and at the same time, I guess being gritty and persevere is something that entrepreneurs have as their fundamental foundation and pillars, and this is just a test of that. But take this advice that Michael and Sebastian have given as actionable, and make sure that you've got cash and you're ready for it to fight another battle. I mean, I think survival is obviously a prerequisite here. Shifting a little bit maybe to M&A and investment banking. Vinny, I'm assuming that you have at Woodside have seen something similar in terms of are deals still happening? Are they on pause? Do you think deals will happen, and again within digital health and within health specifically? And is it going to take much longer, or do you think that companies are sitting on plenty of capital to deploy, and this is the time for them to potentially go shopping?
So it's a great question, and I think it's a combination of the two, where there were deals that were in the middle. I mean, there were term sheets on the table, there were LOI signed, and people are moving forward with it. It's taking a little bit longer than it would have normally taken, and part of it was the remote work, the teams dispersed, so it's taking a little bit longer from that perspective. But companies are definitely sitting on a lot of cash, and also I think the other thing that they're starting to think about now is this the ideal time to actually come in and start shopping around? So I had a call with a public company this morning that has actually now decided this would be a perfect time to start looking for what's out there. The second thing I think is also same thing, we're working with the founders. We're actually talking to the founders and some board members and saying, hey, this is where the cuts need to be made. This is where things need to change, and they need to be able to survive. Some of the previous investors are bridging while the due diligence and stuff is going on. So there's a combination of all of that. But I think definitely activity is still going on. And I think for digital health, activity is actually picking up.
Sorry, excellent. And look, so just pivoting a little bit. And by the way, you know, all these pieces of advice are global in nature. So one positive bit of spin I do want to put on COVID-19 is perhaps for the first time ever, and definitely in modern recorded history, we're all fighting. We're all united in fighting one enemy, right? So rather than fighting, you know, each other and perhaps competing, I've seen a lot more collaboration and cooperation among startups, among companies, quite honestly, globally. But coming back to the original question that I had posed, Michael, just in terms of this new normal, if you will, and this is one of the questions that I grapple with is, you know, looking into the crystal ball, you know, how does that you actually look like? I mean, what is the base of that you? Is it sort of a inverted sort of asymptotic plateau, or do you think, you know, what's the guidance I suppose you're giving the entrepreneurs? Is it going to take 12 months, 18 months to get back to whatever the new normal may be, both in terms of business as well as, again, some of the cultural and work from home aspects that you know, entrepreneurs are currently dealing with?
Sorry, I forgot to unmute. So I agree with Sebastian. Nobody really knows. Like, we have access to a lot of great kind of economists at our disposal, and have been kind of opining with them kind of on a weekly basis to see what they're seeing. What I would say is all of our founders are preparing for the worst, right? They're in survivor mode and they're in plan B mode. And therefore they can activate if it becomes more encouraging and things kind of accelerate for the better. But they're in a more defensive posture than an offensive posture. What I would say is there is nobody that we kind of hold in high regard that is actively saying it's an aggressive V-shaped recovery and we'll be kind of back in full swing, kind of like we were in January or December or November, you know, later this summer. So it's definitely going to take time. I think there's also very few people that are forecasting an L-shaped kind of stasis either, where you're kind of in a very prolonged, protracted kind of depressionary kind of era. So the question is, you know, how long is the U? I don't think anybody knows, and therefore you need to kind of prepare for it. What I can say is, just because, you know, I too, like you, Mohanjit, have been through the global financial crisis, the dot-com 9/11 days, you know, and other kinds of situations, we can't necessarily pattern match COVID-19 pandemic with those events because it's fundamentally different. And it is more global, it's health related, you know, it's also going to be societal and behavior related and all that kind of stuff. So therefore, you could be ill-informed basing off of prior models and trying to predict the future. So again, all we've simply said is assume the worst and assume it takes longer than you think. And what I would also caution folks is, at least in the US, you have to remember in Q4, we have a presidential election, right? We've forgotten that November 2020 is going to be a really interesting event. And that may further, you know, kind of create turmoil depending on what happens. So in general, we've guided our companies, if you don't have to be in the capital markets in the entire calendar year of 2020, best not to, right? And then just try to be available and ready for combat in 2021 and see what that calendar year brings to you.
Fantastic. Just turning to you, Sebastian, briefly. Now, obviously, within health, right? So there's a lot of conversation about this has been a catalyst for many companies, whether it's you know, remote patient monitoring, obviously diagnostics, telehealth, et cetera. Looking at your portfolio specifically, perhaps, are there some of these windfalls that have come through unexpectedly for your companies, and at the same time, which are the segments or subsegments perhaps that might be facing more of a headwind versus some of the others? Again, keeping to the health topic specifically.
Yeah. So I think that in terms of tailwinds, I'm seeing, again, a couple of portfolio companies, they're able to accelerate sort of product development or accelerate towards business goals. And so I mentioned Livongo Health already, but another one I'll highlight is from sort of our bio IT practice, a company called Swift Scale Biologics, which focuses on cell-free biologics manufacturing. And they have seized this opportunity to partner with a company called Centavax to develop a COVID antibody rapidly and get that out into the clinic as quickly as possible. And so, you know, I mentioned them again as another example of someone for whom this has really presented an opportunity. In terms of headwinds, I think the big ones on my mind are the consumer health businesses. Our primary investment there is in Hims and Hers. But I can imagine disruptions with supply chain, and I can imagine challenges with customer acquisition in this environment. But largely, I would say, look, now is a really, really bad time for energy. Now is a really, really bad time for retail and marketing. It's not the end of the world for healthcare, and there are a lot of great opportunities for us. And I think we're, you know, for those of us who are investing in healthcare, we're in some ways fortunate in this scenario.
No, just taking your cue from you, Sebastian. Let me turn to Vinny. What are you seeing? I mean, what is the data telling you? And maybe you can leverage some of the previous sort of the previous two crises and say, you know, was there something that we saw back then that we can anticipate in this particular case? And are there specific segments that you think will do well despite the current crisis?
So, you know, I think to add on to what Michael actually was saying earlier, and even Sebastian, if you look at the previous bear markets, which were usually tech-caused bear markets or other economic crises, capital investment was down, I think about 80% in 2001 and about 61% in 2009, whereas valuations were down, I think 70% in 2001, but only 36% in 2009. And considering this is the first time that the downturn has come because of a virus, I mean, I do think that the valuations will go down. And I think that's one of the reasons, and like somebody else said earlier, you know, the better companies are born, or a lot of good companies are born in crises. So you'll see valuations go down, but you'll also see some real stellar companies that will actually come out of this particular crisis. And I think the other thing to keep in mind is the volume declined for M&A in 2009. Actually, volume increased for M&A in 2009 as compared to 2008. So you will actually see a lot of people stepping up and looking at some of these options. And I think if you don't need to raise capital, of course, my advice to every startup would be please do not raise capital right now. Having said that, I think this time around, there's a lot of dry powder around. And I do think digital health companies, especially with the government initiatives that are coming through, with telehealth opening up, and some of these will become the new normal going forward. So I do think those will actually do better in this time.
So speaking of, you know, dry powder, look, I mean, just in the last 2 or 3 weeks, there have been several announcements made. Just today, you know, Lightspeed announced, you know, multiple large funds, General Catalyst, Mayfield, and as I mentioned previously, you know, 8BC and so on. So there's plenty of dry powder, and many of these folks have actually said specifically that they're going to look for disruptive companies within the healthcare domain. So one of the questions that entrepreneurs ask me is, you know, VCs are sort of talking the talk of, yes, we're still open for business and we're still, you know, meeting entrepreneurs, but are they actually walking the walk? So maybe starting with you, Sebastian, you know, are you open for business? Are you actually taking these sort of Zoom meetings and with an intent to deploy capital? And again, in that context, what's your advice to entrepreneurs in terms of timing and how long it may take, even if you are looking to deploy additional capital in Series A and B? And by the way, do weave in this very interesting bit that you and I spoke about briefly yesterday or a couple of days ago around this incubation model that your firm in particular has, which I thought was pretty unique.
Yeah. So we are open for business, and I don't speak for every venture capital firm, but I believe that when people say that they're open for business, that they mean it. But I would bear in mind that VCs have bosses too, and really I want to call for empathy. Even if you have dry powder, LPs are asking lots of questions about your strategy and how you're responding and how you're managing the portfolio. I talked about a fire drill that many firms just went through the month of March in terms of making sure that our portfolio companies can survive through this downturn. And yes, we are open for business. Oh, and I mean, just like everyone else too, we're getting used to homeschooling kids, working from home, trying to develop relationships of trust over Zoom. We're open for business, but bear in mind that there's just other things around us going on, and diligence processes might take longer. A lot of VCs are coming out of a really intense period working with their portfolio companies. And frankly, with LPs asking lots of questions and really scrutinizing each investment, I think that you're seeing some VCs sort of hew more closely to the areas that they know best, and also focusing a lot on founders where there's a pre-existing relationship. So sometimes founders don't like to chat when they're not raising, but I think this is actually a really strong example of why you should do that. Trust is so important for any investment that we're going to make. And if we're meeting you for the first time over Zoom, it's really hard to develop that relationship. And for people who we knew already, it's like we can really take an earnest look at that round. So things are open for, just to sort of like summarize and put a bow on it, we're open for business, but be empathetic to our situation and understand where we're coming from, and that things might take a little bit longer. And, we might be a little more limited in the types of deals we can look at.
And Michael, I mean, you've got an interesting LP in terms of, a retirement system, and I'm sure they're going through their own shenanigans. What sort of pressure has that put on you in terms of either put the brakes on or still business as normal? Where are you on that spectrum?
Yeah, business is still largely normal for us as well. So across our 3 geographies, we will, knock on wood, close on 6 investments between the March, April, May timeframe. So optically, by the time those investments announce in the public, I just previewed it right here, it's going to look like we've been extremely active during a pandemic environment. But to Sebastian's point, these are typically processes that started well in advance. They're with founders and management teams that we have a prior relationship. They're in spaces that we really know. They're in, we had the chance to do the diligence, the whole 9 yards. There is a little bit of a kind of feint of hand here, which is, yes, I'm open for business. I'm still doing stuff. I'm still announcing stuff. But when did that process actually initiate, and what's the lag in it? I think the bravest VCs are the ones who will say, I've met you, Afsana, for the first time over a Zoom, and I'm going to write you a check for your business, and we've never met, and this is about the sum total of our amount of interaction or familiarity and all that kind of stuff. That is a more challenging model for true institutional investors. I think there are many seed and angel investors who might invest out of geography that are very comfortable kind of doing this type of interaction and engagement model. And hopefully that continues to kind of stand up the ecosystem while this kind of situation occurs. But I echo what Sebastian said. ventures built on trust and relationships. Now is definitely the time to pre-market, pre-sell kind of what you're up to, lay out a plan, show a prospective venture capitalist like, hey, even in the pandemic, this was my plan. This is what I said I was going to do. If you can come back to him or her 3 months, 6 months, 9 months, 12 months down the road and say, I executed on that, that's going to buy you a whole heck of a lot of trust. So I think that's kind of, frankly, where we're at, despite all the noise and kind of the Twitterverse of people saying, yeah, I'm still open for business and all that kind of stuff. Because no VC is going to tell you they're not open for business.
No, thank you for your candor, Michael. And Vinny, you spend a big chunk of your time speaking with investors as well. Any views on this particular topic from your point of view?
So, interestingly enough, yes, we're also hearing all the VCs say they're open for business. I've had a few webinars and few virtual panels with several of them. One of the things that they've been pointing out is something that possibly was not of high importance, and now all of a sudden it is. So they're talking to different innovation groups, and all of a sudden they're realizing robotic cleaning for a hospital is important, because we need that done. So in hospitality and in healthcare, mental health was already on a tear in the first quarter of 2020, and it's really taken up even more, especially as anxiety builds up and people are starting to feel more and more cabin fever and starting to realize how to balance this new normal. Mental health is, again, just from the revenue perspective, is really on a rise, and I think VCs are definitely taking a note of that. Interestingly enough, corporate venture groups and corporate M&A guys are definitely, this is the time, they're definitely in business. They're calling and saying, hey, this is what we're looking for, whether it's for team, technology, or getting access to new markets. They are definitely looking.
No, fantastic. But, one of the positive spins I'll put on this is, you go back to the 01 timeframe, you go back to the 09 timeframe, and some really interesting companies were created during those periods. So I would say, in sort of conjunction with what Michael and Sebastian and Vinny have said, entrepreneurs are entrepreneurs, right? So they see opportunities. They know that the odds are against them, that they will succeed, but despite all that, they barrel ahead. And so, I've been actually spending time just building those relationships, building that trust over Zoom. Hopefully, it'll convert to in-person interactions relatively soon. But those who are fundamentally believers in their value proposition, and again, despite the headwinds, despite the fact that it's going to take much longer to convince VCs, they're pushing ahead. That to me actually signals something, really interesting and really compelling about the individual or individuals. So I would say to, again, the entrepreneurs in the audience, again, you have to be able to tell, the narrative has to be there, the value proposition has to be there, on the vitamin to cancer drug spectrum, be closer to the cancer drug side than vitamins. But I think, and I predict that, over the next few years, we'll look back. And I've sort of coined this phrase called hindsight will always be 2020. And so you will look back at 2020 and say, some remarkable companies were actually created in this era. No different than what's happened, during the previous dips. Now, just a final, I guess, set of questions is, are there specific, and you've alluded to this a little bit, but are there, if there are, again, entrepreneurs in the audience who are saying, what are the key segments? When you look at your portfolio and you see some white spaces that either were emerging or really have been, thrown to the forefront because of this pandemic, are there specific areas of real interest? And again, companies may be looking for capital downstream another 6, 9, 12 months or beyond. But if they happen to be in particular subcategories within health, they should definitely seek you out. Is there something that's sort of a burning hole in your overall portfolio that you're keen to speak with entrepreneurs about? Michael, maybe you can start.
Sure, I'll start. I'm going to answer your question slightly differently, which is, when we look at healthcare investing, we always focus through one lens on how do you get compensated, who's paying, right? The unique nature of the U.S. healthcare system is you need to follow the money and figure out what business model or what go-to-market model there is. So my roundup on that is, providers and health systems right now are super swamped. They have other priorities. So if you're selling software technology to them, that's going to be a really challenging sales cycle. Okay. I think anything on the life sciences biopharma side that still needs a lot of FDA kind of approval and attention, that's going to be equally challenged as well, because they have vaccines and diagnostics and tests and all that kind of stuff they need to be focused on right now. So, in one regard, some of the DTX, digital therapeutics players that are still kind of going through that kind of stepped process, it's going to take a little bit longer. I think employers, health plans, kind of payers effectively, that could be still fertile ground for many things, right? Because they are underwriting the lion's share of the cost for most of this kind of stuff. So, we are predisposed generally to those market segments anyways, and we think they're still relatively in the clear in light of this. I would say, within the first few weeks, we got a lot of pitches on COVID testing and therapeutics and all that kind of stuff. That's gone, meaning like you've got to be a company up and running already working on something there, because if you're starting today, you're going to miss the whole boat, right? So I think for us, we're still looking for things that have great tailwinds. They can have short-term headwinds as a result of this, and who's not facing headwinds, but we're looking for large kind of market opportunities kind of down the road. And I'll kind of further articulate this by talking about musculoskeletal and kind of the orthopedics world. So today there was an article that the trade groups for all the orthopedic surgeons in America were up in arms because they want their piece of the CARES Act. They want their PPP. I mean, these are people making $500,000 a year saying, I can't do my knee replacement surgery. I can't do my shoulder, my hip, and all that kind of stuff. Woe is me, I'm down 90%. I'm not sure CARES was meant for guys like you, but I get how your business has dramatically changed. Same thing, the other day, there was an article in the Wall Street Journal where it profiled a physical therapist. She's a small business owner with a couple of live PTs on staff, and her revenue is now down 70%. And she's trying to figure out, how do I do teletherapy? Because, I used to have 70 clients a week. Now I'm barely able to hold on to 12 or 20, whatever the article said. So, this is interesting because, we're involved with a company called PureWell, which is musculoskeletal condition management. It's a software solution focused on patients who are either trying to avoid surgery or destined for surgery, but they're trying to optimize that surgical episode, okay? Right now, as we all know, orthopedic surgery is off limits. It's not essential. It's viewed elective. So therefore you can't do any of this kind of stuff, right? So they're all sitting there kind of waiting, for the window open. And therefore, what are patients, prospective or active patients, left to do? They have to suffer in pain, suffer at home, find alternatives to just stave off that surgery until they can get back in there. So that's why surgery avoidance is more important. That's why anything is more important for that. And then where it ultimately leads to, and this is fascinating, is we all talk about flattening the curve today on COVID cases. There's going to be another tsunami. I don't know when it is, 3 months, 6 months, 9 months, 12 months down the road, of just healthcare utilization full stop, because healthcare utilization has completely stopped in America, other than like super urgent care and COVID related emergencies. Everything else is off the books. You can't go see your eye doctor. You can't get your teeth cleaned. You can't get your knee done, none of that stuff. So there's going to be a surge in utilization at some point, and there's actually going to be a flattening of that curve, because I don't think our existing healthcare system can handle it when everybody's ready to go get their knee done, and all of a sudden you're calling the same orthopedic surgeon. So, through PureWell, they're seeing massive demand of their solution from industries such as grocery and food and beverage. So think about that. If you're a grocery frontline employee, you're working 12, 14, 18-hour shifts, stocking shelves and all that kind of stuff, getting injured, tweaking your back, hurting this and that, right? You probably need surgery now, but you got to fight through it. Flip side, hospital workers, that's a physical job normally in the hospital, yet they're not, filing claims or going through any of this stuff because they can't. They're truly the wartime front line. They need to get back into action, right? So we're having really insightful kind of purviews into what's happening in society in America, from healthcare utilization, who's still utilizing, who's not, insights into like when that backlog might kind of materialize, and then kind of, what's going to happen in that case. So I think there's permanent things like, hey, anything telehealth related is one of the go forward modalities. But I also think if you have to parse through either its conditions or other parts of medicine and kind of where they play as a result of a lot of deferment for however many months this is going to be.
No, very interesting. I think follow the money is the mantra that everybody should be following, and hopefully there will be some interesting changes that last, through reimbursement shifts that are going on currently. Sebastian, what would you like to add to that? And then I'll go to Vinny. And this is sort of the last prepared question. Then we'll open it up to the audience. Sebastian.
Yeah. So I'll add a bit to what Michael was saying. One of the themes that I thought a lot about before COVID was the unbundling of the hospital. And I'm a big proponent of, if anyone's familiar with Regina Herzlinger at Harvard Business School, when she talks about health factories, I'm a big proponent of building out models of care designed for specific disease states and building efficiency and high quality operation around that specific disease state. And I think that COVID has accelerated a lot of these groups that were taking elements of care delivered in the hospital setting and shifting them to either virtual or to the home setting. I'm thinking of companies like Cricket Health, which is focusing on chronic kidney disease and stage renal disease. But you can apply this to sort of many different disease areas. And I'm excited for what will hopefully be a renaissance with these sort of types of companies. In terms of payment models, long discussion to be had about how these are evolving. I think a lot of it happens independently of COVID, but I'm excited by the number of providers that are willing to take risk. I think that this sort of aligns incentives well, but also allows top quality providers to earn higher margin when you're actually bearing risk on patients that you're taking care of. So I think this is going to be a really sort of exciting 2-3 years for our healthcare system. And I'm really, really, really optimistic that we're going to see some great companies come out of this whole crisis.
Thank you. Vinny?
So, to add on to that, I'll leave you with an interesting fact here. So one of the segments in healthcare that has avoided downturn or downward movement in any crises is patient care. So if you look at the 2001 data, the M&A deals actually for 2002 grew almost 12% for patient care. And as Michael and Sebastian said, first of all, follow the money, but also what can we do to actually get the care to a wider segment? I mean, people are going to be calling in. Right now, we've got ophthalmology, dental care, any kind of exam that you need. I mean, I've got my son who actually needs to go see an orthopedic because he's getting a little valgus up his foot, and he's an athlete, but I can't get an appointment. There is no appointment. There's pediatricians that pushed off their physical checkups. So telehealth will definitely see a huge increase. Now, one of the advices that we give to our startups also is, especially when they're coming through us, depending on where they are, if they're raising, or you can run a dual track, right? So whether it's from the perspective of figuring out where your market placement will be, it can be done either way. But I think telehealth is definitely one, mental health, and any services that actually provide the platforms that, like for chronic disease management, if there's a platform.
Thank you for that. One thing I will just mention quickly to Michael's point, which was the surge. Maybe it applies to health, but I think it applies more broadly, is if you have capital, and if you have, let's say, 15, 18 months plus, planning and getting systems in place to take advantage of that surge that's clearly coming almost across any segment. As long as you're up and running, getting some of those systems in place will actually benefit you tremendously. And that's one of the positives that you could do in this lull that you may be experiencing in your core business. It's just something to keep in mind. With that, Afsana, I will hand to you perhaps to curate some of the questions that have popped up and let you go from there.
Sounds good. Thanks for the excellent discussion, everyone. I think that all very, very relevant topics. I'd like to just start with one. I think there was really good discussion about the increased need and in use of virtual care across primary, all specialties, telemedicine. And, I work in that space. So 6 months ago, what might have seemed like a very crowded space, no, we don't need another virtual diabetes, hypertension, behavioral health solution. It's a very different story now. So I'd love to hear the investor perspective on that. Like, do you think these companies, and you can see it from the stock, I'll pick my two favorite, Teladoc and Livongo, just in the past week, their stock has just, done very well. So are you actually actively seeking out companies like that to invest in or doubling down on companies like that? What is the investment scenario for those types of businesses? Whoever would like to answer.
You alluded to it a little bit. Maybe you want to just peel the onion a little bit more, and then Sebastian, I'll turn to you.
Sure. So I think what I'm hoping is that in a little bit, we don't talk about tele X, whatever X is, as a thing anymore. And it's just part and parcel of the solution. Just like today, we don't talk about mobile X, whatever that is, right? Like mobility is just kind of inherently built into a lot of things that we see and do on the consumer side. I think, we like to see companies we work with be multimodal. So whether it's tele or it's in person, or other modalities, it's kind of like meet the patient where the patient is, right? So I think this, as many articles have been written, this has probably moved the telehealth movement by 7 to 10 years in 1 month than they could have done so on their own. And when you see kind of CMS doing a lot on reimbursement kind of tweaks week after week to kind of facilitate that, you see all the payers getting behind it. I think the horse is finally out of the barn and we can kind of put an end to that debate. So I'm encouraged on that front, but I'm hoping for a world where we don't have to talk about tele blah, 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 and it's just kind of inherent in the solution.
So does that mean that for you, it's now table stakes, or do you invest more in that? Does it basically give those companies more access to capital?
I would say it gives the ones that are up and running access to more capital, more growth capital. I would say if you're starting de novo today, it can't be the main thesis of what you're doing. It's got to be part of something more holistic, right? And to your point, Teladoc is trading at it's a 52-week high. It's all time the stock's ever been, right? But if you're like, hey, I want to do telehealth for urgent care, primary care, I think it's a little late sitting here in like Q2 of 2020 to start a business on that front. So whether it's other specialties, other kind of slivers or other niches or enablement, I'd probably be looking at those types of opportunities. But I don't have a big tele thesis per se. We're looking more holistically at musculoskeletal or fertility, right? Or pharmacy or these things of which tele could be a component of the model. Gotcha.
Okay. Do others want to add anything? If not, we can move on to some other questions.
Please, Sebastian or Vinny, I think you have something, and I'll turn to you, Sebastian.
So, I think one of the things to add to that is if you're starting today in telehealth of any tele-X, it's obviously not the right time. But if you were stuck at a point where you're trying to figure out what your next steps are, now would be a perfect time to look for a strategic partner. Right? So that would be my advice to those companies because the payers are looking right now. They're definitely paying attention, but along with that also, right, it's not just in health, it's also in education. I think Cisco, Apple, a bunch of them have actually now been talking about remote education very, very seriously. So this has definitely started that new trend too.
Great. Okay, excellent. There was a question on privacy. With the pandemic crisis, do privacy and PII issues, is the bar going down or up? What are your thoughts on that?
Who wants to take that one? Sebastian, you come from the Palantir part of the world, so you may have a thing or two to say about that.
Yeah. So yes, my background, I didn't actually talk about this in my intro. My background is that I was at Palantir for 4.5 years running our healthcare business before joining ABC. So I've worked with a bunch of health systems and pharma companies and payers. And I speak for only myself when I say this, but I think that HIPAA tends to be an excuse to not do things. And I tend to think that it often gets in the way more frequently than it helps. And I think that it really slows down the delivery of a lot of things that would make patients' lives easier and get Americans better quality care at a lower cost. What you've seen, I'm thinking of one particular action, although there's been so many sort of quick policy changes, it's been hard to keep track of them. One thing that you saw was waiving the requirement to use a HIPAA-compliant teleconferencing tool for telemedicine during COVID. And you've seen a bunch of doctors just, able to get on Zoom, able to get on FaceTime and start talking to patients. I think that this is going to illustrate to patients, to some extent, what taking a different stance on privacy can enable and what sorts of things can emerge from it. I don't know what's going to happen at the end of this, but my observation is that policy changes introduced in emergencies tend to stick around. So I think that this is probably going to just loosen up a lot of restrictions that existed in the past.
Great,
Yeah,
thank you for that.
A heck of a case study on a global scale in terms of the continuous tension between privacy and utility, right? And I think I do agree with you, Sebastian, that people are going to be more willing, right? What the millennials and the younger generation already do in terms of their social media, no such thing as privacy. I'm not saying go that far, perhaps, but definitely this will trigger discussions in that direction.
Right. There are a couple of questions on cancer, so let me kind of bundle those together. So the questions are sort of, what about cancer and life or death interventions or therapies related to cancer, how they're allowed or not allowed during COVID-19, discussion of clinical trials being canceled, and what does that mean for some of these, therapies that were about to go into clinical trials that were related to cancer. So I don't know who might have a perspective on some cancer-related progress and therapies.
So, one of the things we've been hearing actually on our end is, especially from the clinical trial perspective, which had slowed down initially, and that's where actually remote management and remote observation of patients have started to come in. So some of that is actually the new wave where we're seeing people actually being administered, a company like AI Cure and a couple of other ones which are actually monitoring remotely how the trials are going. I think some of the cancer-related and some of the other diagnostic-related clinical trials are starting to pick back up. It just depended on where they were in the supply chain mess when it first started. That's pretty much been what I've been hearing so far.
Gotcha. Okay. There was a question around geographic focus. I think, let me maybe add some flavor to this. The question is, for you, has your focus narrowed at all geographically? And Mohanjit, I know you do a lot of international investing as well. So maybe the question is, has your geographic focus changed at all in light of the crisis?
Well, let me go first, but really it's to Michael and Sebastian. So I am a global investor. I invest primarily in, as I said at the onset, U.S.-India corridor. So I'm probably the most flexible of the bunch. My whole purpose in life is to find companies across the U.S. that can impact audiences or markets in that part of the world, and at the same time find young gems that are doing something really compelling in India or Southeast Asia and help them open up markets here in the U.S. So I'm trying to sort of democratize, entrepreneurial meritocracy, if you will, and open up channels across the globe. Having said that, I think depending on where you are in the spectrum, if you're an angel, there's always been this propensity to be close to your investments and to be able to, there was a phrase that you should be able to drive to your investments if you're an angel investor. And there are others, you know, who basically, even after last crisis, they said, look, we want to be focused just on Silicon Valley and nowhere else, just because there's plenty at the top of the funnel in terms of opportunities. But I'd be curious, maybe Michael and Sebastian, I mean, my gut says that you are looking for opportunities not in a particular geography, and I don't think that's going to necessarily change. You will go where the best entrepreneurs and the best opportunities are.
Yeah, I'm happy to start first. So we will, as a fund, given our 3 locations, invest in the US, in Canada, and across Europe. And we have local teams in each of those markets. So the team here in Palo Alto focuses on the US in particular, because each of those markets, the healthcare system, and again, who pays, follow the money, is slightly different, right? But within the US, we're indifferent between West Coast, East Coast, Midwest, et cetera.
Okay.
Sebastian, anything you want to add?
Yeah, no, VC is easy. We primarily invest in the United States and a little bit in Western Europe, but our healthcare is and continues to be focused in the United States just because our healthcare system is so different, you know, from any European countries. I think one interesting thing is that we are exploring opportunities in Latin America. And Brazil, actually, a good chunk of the healthcare system actually resembles the United States. This was a little bit experimental for us, though, and we started to get our toes wet, and we're gonna pause that for a little bit, focus in the U.S. for now.
Okay.
And Vinny, anything on the strategic investment side? Are they agnostic, or are they looking at something specifically?
So I think it depends on the strategic particularly, but they are definitely open at this point for business there, especially if they were looking to expand geographies. This would be a great time to pick up companies and pick up teams internationally. So we work in our headquarters in Palo Alto, but we actually have a very strong presence in London and in China, and we're definitely seeing a lot of activity there. So.
Great. I think that's it for questions from the audience. Mohanjit, any final words or questions you want to share?
Yeah. So look, I'm gonna tell you something which is a secret within the venture firms, and my colleagues hopefully don't. You know, since we're not in the same room, you can't really do anything. So you know, flip me off if you like. But here's at least my take. Okay. So we have the best jobs in the world. So if you think about it, we get paid to become smarter every single day. So you know, and those in the audience, I don't know exactly the makeup of the audience, but I know there are many entrepreneurs. And what we do is we learn from all of you in terms of the top of the funnel. You're in the trenches. You're telling us the issues that you're dealing with, and obviously the big problems that you're solving. And I have this this term which I call, you know, the coefficient of suction, right? So it's just how much of what you impart do I actually retain? And if I do that on a daily, hourly, weekly, monthly basis, I am a better person at the end of every hour, at the end of every day, every week, every month, every year. And it's not because I am, you know, smarter than you. If anything, I'm not. But I am just always being, you know, I'm drinking from the best fire hose in the world. And so what I do, and I'm not saying this for Sebastian and Michael, who are brilliant, but I take this incredible knowledge that I get from entrepreneurs, and I spend time sort of thinking through and analyzing, and put a wrapper on it, and use that knowledge that has come walking through my door, and then, you know, analyze it and take the end product and dish it out to other entrepreneurs, right? So it's not necessarily that I, again, speaking for myself, are really, really smart people, but we just get surrounded by people who are much smarter than we are in a particular domain. And so I'm humbled by you know, the caliber of questions, the caliber of my panelists, and I think I'm a smarter person at 7:01 p.m. than I was at 6:01 p.m. for sure. And with that, I would love to maybe if my panelists have you know, ending remarks, please opine. But I just want to thank everyone, and I just want to say, you know, be well and be safe, both mentally and physically. But with that, if all of you have you know, last sort of words of wisdom, I'm sure the audience would love it. So maybe Michael, you start, and Sebastian, and then finally Vinny. Please take it away.
Yeah, no, I mean, first for the entrepreneurs that are on the Zoom, you know, all credit to you. You are the pioneers, the brave, you know, kind of doing things and pushing forward. So, you know, without you, we wouldn't be here. I would say we're in uncharted waters with this pandemic, and all of us are blessed to be on this Zoom call today, because it means that we are safe and healthy for the time being, and hopefully we continue to be that way. This pandemic has exposed a lot of unfortunate kind of weaknesses in the U.S. healthcare system, right? And what I'm hoping at a policy level or at a structural level, that brighter minds and people in power will do things to kind of try to re-engineer change and tweak things, you know. I think the rich get richer, you know, when you look at some of the corporations in the healthcare system and what they're reporting on earnings and all that kind of stuff, and the poor get poorer. And we've seen the disasters from the demographic data on who's falling victim to COVID and all that kind of stuff. And clearly our system is not working when you look at the rest of the world, in particular certain parts of East Asia, which are just kind of laughing and mocking kind of how the US has kind of squandered this opportunity. So I'm hopeful for a vaccine. I'm hopeful for more testing. I'm hopeful for the leadership from our public servants here on the West Coast in particular to kind of see us through it. And I'm hopeful that you guys will all come and find us at Omer's Ventures or 8VC or Woodside or Iron Pillar and continue to have the conversations with us, because we'd love to be involved with you on your journey. So thank you for having me.
Hear, hear. Sebastian.
Yeah, two things. One, on the best of days, Palantir was the hardest thing I've ever done. So for the entrepreneurs who are operating through this sort of environment, you guys are heroes, and I have tremendous respect for all of you who are working through this, particularly those of you who are making some really hard decisions about team and strategy right now. But I think point two, I want to build on Michael's point, and this is a little bit the Palantirian in me speaking, but Washington needs people who understand technology badly. And if you see what the federal government is doing and you think they should be acting differently, let this be a little bit of a nudge to get involved. There are a lot of roles in NIH, CDC, CMS at the HHS level that really could do with top Silicon Valley talent, and I'd love to see more of us actually get out to Washington.
Great. And Vinny?
Oops, sorry, I was on mute. I think I would add to that, which is, you know, the more people get involved, the better off we will all be. And remember, amazing entrepreneurs do amazing things in hard times, good times, and in all times. And we're counting on you guys to continue to do that. And if you're in healthcare, I think the best part is that's one industry that always seems to do or fare better than the other one.
Afsana, maybe final words from you. You're on mute. You're on mute.
Sorry, thank you. Yeah, I just want to thank our panelists and also the MIT community at large. I think I've seen the community really come together in a way to bring events, to keep that connectedness for all of us. So I wish everyone continued good physical health, stay healthy, but also leverage this community around us to stay strong and continue to move forward. So with that, thank you everyone and have a great evening.
Thank you all.
Bye.
Bye.